Hey guys, on Tuesday, the Fed took a break from playing arsonist and played fireman, sounding the alarm that trillions could start draining out of banks in a silent bank run, implying yet greater several trillions could soon drain out of the U.S. economy. This could endanger the banks yet again, driving them yet again to the comforting embrace of taxpayers eager to sacrifice our life savings to cover their gambling debts. More important, and as a creative thank you for our generosity, this could crush the economy. In the Fed's paper, they looked at the past two rate hike cycles starting in 2004 and 2016. In each, they found a big jump, trillions, going from banks into money market funds. Now, money markets are like a bank account, a nice place to park your dollars, but this is key, money market funds cannot be fractionally reserved. That means that while a dollar in the bank system is spawning roughly $3 more via fractional reserve, like hamsters, they multiply, a dollar in a money market fund is just a dollar. It's not quite as good as a full reserve bank. After all, money market funds still put your dollars in risky government bonds instead of cash, which is king, but they're close. In gory detail, in the 2004 cycle, money market funds doubled from about $1.5 trillion to $3 trillion. And in 2016, they rose 40% from $2.5 trillion to $3.5 trillion. Why did this happen? For two reasons. First, because high rates mean the gap between what you make in the bank and what you make in a money market fund is bigger. You're losing more sticking with the bank. For example, in 2020, interest rates were about zero, and both money markets and banks also paid about zero. But with rates almost 5% now, money markets also pay about 5%, but banks still pay about zero. Second is fear. In the 2008 crash, and again during COVID, money market deposits rose because of fear the banks would collapse. After all, the kind of people who move billions in and out know it's a Ponzi. They know that banks are permanently bankrupt, living handout to handout. Note, both hike cycles were smaller than today. The 2004 cycle was about 4 points in 2 years. The 2016 cycle was about 2 points in about 3.5 years. Today's is already bigger than both, and that's in a single year with more to go. So now we have a perfect storm. COVID fear, epic rate hikes, and a 2008 all rolled into one. All right, what does this mean for the rest of us? More pain. The reason is that thanks to Wall Street's fractional Ponzi, every trillion going out of banks into safer assets like money markets perversely shrinks the economy by several trillion. The fractional reserve pretend money vanishes. So yes, the economy is living on risk. This shrinkage hits hardest in loans. With trillions less to lend, banks will stop making loans. They'll stop renewing loans. They could even call in existing loans. So businesses are strangled. Essentially, the economy shrinks from its current counterfeit fortified size down to its true size. The artificial boom, based on artificial money, deflates. Unfortunately, right-sizing the artificial boom means a lot of bankruptcies. It means a lot of layoffs, a lot of jobless. If you like your job, you cannot keep your job. Of course, the economy is already shrinking, even today, without the extra help. In Wednesday's video, I talked about job openings crashing. They're down 1.2 million in about the past 2 months, and fresh jobs numbers this morning are already looking grim. Toss in another couple of trillion, draining out in a flight to safety, and it could get bumpy. All right, we'll be watching. See you next time.